Hello, future billionaires. Welcome back to another episode of the Invest Like a Billionaire podcast. Today's guest is Steve Coughran of Coltivar and Boosting Your Financial IQ. Steve is a very smart guy, and really excited to have him on this podcast. He is really a strategic CFO, has been with many venture-backed companies helping them scale and grow, and now runs a consulting practice for entrepreneurs and business owners looking to maximize the value of their businesses and to continue to scale with kind of the financial edge that he has. So he kind of takes this mindset and approach that he uses for entrepreneurs and business owners, but also applies that to individuals. And how do we, maximize our personal financial wealth, our situations, and really free cash flow, understanding the reasons why cash flow is so important. And so he has a great platform called Boosting Your Financial IQ. I was just on his podcast a few weeks ago and had a great conversation. So there's a lot of nuggets you'll want to pull out of this. I think you're really going to enjoy it. So tune in and enjoy the episode. Thanks. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments, so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Hello, future billionaires. Welcome back to another episode of the Invest Like a Billionaire podcast. I am your host today, Ben Fraser. And we've got a really exciting guest, Steve Coughran. He's the founder of Coltivar, which is a consulting firm that helps empower companies to drive successful financial, operational, and strategic transformations. He was a strategic CFO for several companies for many years and now runs several media companies, really helping investors, individuals, as well as businesses to just boost their financial IQ, which is actually the name of one of your media companies. So Steve, thanks so much for coming on the show.
Yeah, absolutely, Ben. It's great to do this conversation now on your podcast. Ben did an amazing job on the Boosting Your Financial IQ podcast, where he was talking about real estate and private equity and investing in all different types of things, which he did an amazing job on. So I'm glad to be here with you.
Yeah, thanks, man. I appreciate that. And we had such a great conversation during the podcast and afterward that wanted to have you on our show and just talking about some of these things that I think are really important for investors, just individuals to understand, just coming from your background as a CFO, knowing the numbers and using that knowledge to really boost your financial IQ as you're looking at investment opportunities, you're looking at portfolio allocation, as you're looking at all these things to kind of go back to the basics. And so I thought it'd be great to bring you on and just kind of hear some of those things that you've really studied and have built out an amazing repertoire of knowledge on. So before we get into that, share a little bit of your background, so people have a context for who you are and then some of the media companies you have and what you're doing really to help kind of further this message.
Yeah, absolutely. I mean, when most people think of a CFO and somebody where I'm at today, my path is definitely not linear. So I started my first company when I was 16 as a landscape design build firm. It was by total mistake. It was just supposed to be a summer job, but then it grew into this multi-million-dollar business. I did that for 13 years. I gained a lot of experience just with like design and networking skills. A lot of my clients were CEOs and executives and entrepreneurs who had successful exits in their businesses. And therefore that's when they were hiring me to spend, several hundred thousands of dollars on their landscaping. So as a young lad, I learned a lot about business and learned a lot about just working with people and building relationships. Then I moved forward and I worked for Ernst & Young in public accounting as a CPA. And that gave me great exposure to a different scale of businesses. And one of my clients was a financial services firm, and they had $22 billion of debt. and they were paying about $2 billion in interest a year. And what I realized during that time is that their leadership, they were creating these strategies, and the financial teams were building these elaborate forecasts and financial models and budgets, and the two things weren't connecting. And that's when a light bulb went on in my head, and I was like, okay, there's this massive disconnect between strategy and finance and how those two things come together to drive value. So that's when I left. I started my consulting firm called Coltivar, and I spent the next decade turning around and growing companies. And, I worked with several companies in different industries. And I also, during that time, became a CFO of some of the portfolio companies or clients that I was working with. So I worked as a CFO for a renewable energy company where we're building massive solar farms out in the desert, utility scale solar farms. And then I was also CFO of a fintech company where we raised about $100 million and grew our enterprise value to nearly $1 billion within a couple of years. So that was a really exciting experience. So I've raised capital. I've been part of that process. I've done many acquisitions, been involved in the private equity world. And now, like Ben mentioned, I still do turnarounds and help organizations grow, but I'm also building out a financial media platform called Boosting Your Financial IQ.
Very cool, man. That's a really, really cool background. So you've seen everything from, you said, lawn, landscape and design, $1 million businesses to $1 billion of interest payments, per year, which is, a pretty big, range of a size of companies. But I would imagine there's a lot of, similar, just concepts and things that you can apply at any level, right? And so kind of just distill for us some of the things that you saw that was happening to these big companies they weren't really paying attention to. Obviously, the impact there is a lot greater, but how do you kind of translate that to, the more personal side of things? So you have your brand, Boosting Your Financial IQ, and your podcast, Boosting Your Financial IQ, and really kind of focus more into individuals. What are some of the concepts that you find most people kind of have a challenge with or struggle with or really understanding?
Yeah, no, that's a great question, Ben. When I think about financial literacy and financial illiteracy, which is a major problem out there in the world, there's the personal side, but then there's also the business side. So I believe that business is an amazing vehicle to transform lives and communities and families and so on and so forth. Like if business is good, life is good. If business sucks and you're a business owner or an entrepreneur, like life's going to suck. And what I found is that working with these companies, you have different functions of the business. So you have sales and business development, legal, the people side, marketing, FinOps, that's my department. And you have all these functions of a business, and you have these functional leaders, but so many of these functional leaders, they don't have the financial literacy skills necessary to drive value in the business. So let me explain here. I don't think people need to be like green shade wearing nerds in the back office, like doing debits and credits, and everybody in the organization understands how accounting works and how financial statements come together and what the general ledger is and all that stuff. I don't believe that at all. However, I believe every single person in an organization, they impact the financial statements. There's people that impact revenue. You have sales and marketing. You have people with cost of goods sold that impact labor and the efficiency of labor and material purchasing and procurement. Then in overhead, there's overhead structural choices and how the business, the cost structure that makes it the business. Those types of decisions are made throughout, every single level of the business. So I believe that people should have some level of financial intelligence when it comes to business so they know what the value drivers are, so they know how to maximize the value of the firm. Otherwise, you're just going out there and you're playing to play. And what's interesting, Ben, is that when I wrote my second book called Outsizing, I did this study, and I took 363 contractors, landscape contractors, or construction contractors rather, and I chose the construction industry because I had proprietary data where I was able to compute the economic profit of these companies. So not just like the profit, the accounting profit that just says, here's revenue minus cost, here's your profit. That's what most people look at. But I computed the economic profit, which accounts for working capital and capital expenditures, which aren't on the income statement, right? So I computed this for 363 companies, and then I mapped it. And these are companies with a few $1 million revenue to $1 billion revenue. And I charted it out, and I got this curve, right? Where it's like, it's down here in the bottom left-hand corner, it's negative, and then it curves up to the right. What I found out of this is that, 20% of the contractors, they were earning 83% of the profits, which follows the Pareto principle, right? It's like 20%, 80%, 20-80 rule. And then the top 10% of companies were capturing 63% of the profits. So everybody else in the middle, they're just playing to play. And I think that's so true with other industries, because after the construction industry, I went through and did this to other industries, and the same results apply. So Ben, what I'm saying here is that so many companies out there and entrepreneurs, they're just playing to play.
Yeah.
They're grinding, they're working hard, they're looking at their income statement. Oh, okay, I made $100,000 this year in profit. Yay. But then it's like, oh, I got to reinvest that in, equipment or, other types of investments. And that cash goes out the door, or it's tied up in working capital. And I think there's this massive disconnect in understanding there in the world of business. So I'll pause there, and then I'll talk about how that relates to the personal sides.
Yeah, no, I think that's so interesting. In, a lot of people that we work with, as investors, a lot of them are business owners, right? One of the greatest ways to build your own, net worth and financial kind of stability is being an entrepreneur. But a lot of times entrepreneurs, they want to just run, they want to do the business. They want to make the sales. They want to go and, have the vision and, oh, I don't worry about the accounting. That's just my CPA does that. Or I don't worry about, the financial statements. And most of the time it's just, they don't understand it. But even going back to my time, I used to be a commercial lender and a banker underwriter. And you find this all the time, right? Especially kind of the lower level, several $1 million businesses versus the billions, the smaller scale, small mid-market. There's definitely a lack of financial literacy and really understanding. To your point, if you just look at the bottom line on the net income, on your income statement, that doesn't necessarily mean your business is super healthy. You have to kind of look at it as a holistic thing, understand, the cash flows, which we're going to get into in a little bit. But before you kind of get in the personal side, what really drove the differences between those, top 20% of the businesses, even the top 10% versus the average, right? Just to break down the Pareto principle, like you mentioned it, and generally it's can be applied in, almost anywhere, but 20% of, inputs produce 80% of outputs is kind of the simple way to think about it. So 20% of your sample size represented 80% of the cumulative profit of that group. So talk about what are some kind of like key things for those that are listeners that are entrepreneurs and run their businesses. What are the 1, 2, 3 punch that were the kind of separators from those averages to the kind of top?
Yeah, great question. I think most people think, oh, the players with the scale, with the top line scale, are the ones that are capturing all the profits. So if you're doing $1 billion in revenue, of course you're going to be in the top decile. That's not true. Like a lot of the big companies earning $1 billion, they're competing in like decile 2, 3, 4, and they're just playing a play as well. So really the differentiators are those that have a solid strategy. That's the first thing. And I'm not talking about like that marketing gimmicky strategy where you're like, hey, let's get together and define our mission and vision and values and create a mission statement for the next 5 years. Like that stuff's great. Like no doubt you should have that as a foundation of your company, but that's not strategy. SWOT analysis, I'm sorry, that's not strategy either. You're just identifying your strengths, weaknesses, opportunities, and threats, putting it up on the wall and saying, okay, there's a strategy. The strategy is determining, okay, what's our shared vision with, everybody, with our stakeholders, our customers, our employees? What's our go-to-market strategy? Like, where are we going to compete and position ourselves geographically to capture, competitive advantages? What are our activities? Are we using technology? Are we outsourcing? How are we streamlining, all the activities of the business? And then what are the returns and resources that are required based on the strategy? So it's a real hard look at the business and making trade-offs in order to drive true business value. So that's what I mean by strategy there. I'm not going to go into too much more detail, but a really good strategy was ingredient number 1. Ingredient number 2 is the people. So high-performing teams. So you could have the best strategy in the world and a terrible team, and you're not going to drive value.
Right.
Now, a high-performing team, it is built on having this clarity and this alignment at the top with strategy. Number 1, that's why I started with that. But then also it's empowering your team and it's building that trust and it's executing and achieving results. And that's what keeps high performers around. So high performing team is really, really critical. And then I think the third thing is just an understanding of, the financial drivers. So many consultants, and I can say this because, I've consulted tons of companies. Tons of consultants destroy businesses. They do. They come in and they're like, hey, we're going to cut your overhead because that's the easiest thing to do. We're going to come in 1, 2, 3 punch, cut the overhead by 20%. You just boosted profits, and then we get the fee and we're out the door. And then little do you know that you just, laid off your most valuable employees, right? That are driving all the value of the company. You just fired them because they have the highest salaries. And yeah, you saved $2 million in the short term, but now you don't have the ability to generate that revenue in the future. So I think understanding the value drivers and look, price premiums and lowering your cost, your cost of goods sold. Those are your two ways to maximize value. Those are the easiest ways. But most people go to cutting G&A overhead cost and growing without having that margin improvement, and then you just grow yourself out of business. So those are the three things that I've seen as characteristics of those who play at the top.
That's really interesting. And I think we're kind of segue here. And I want to make a little comment because one of the things that I noticed as I was doing, banking and kind of small middle market companies, we all heard the stats of, the number of, small businesses that go out of business every year. It's difficult to last more than a couple of years, especially as a smaller business. And a lot of times you actually think just economies of scale, the bigger you are, the easier it is to survive. But one of the things that was so interesting is 2/3 of the businesses that go out of business every year don't go out of business because they don't have customers, they don't have revenue. It's actually because they don't understand cash flow. They don't actually have the ability, they're actually making money, but they don't have the ability to pay the bills when they need to pay them, and they're not managing their cash flow cycle. And some of these businesses, landscaping is a great example where it's more of a seasonal business. You have to understand the ebbs and flows of cash throughout the year. And, this will apply kind of the personal side as well, but talk a little bit about cash flow, why that's so important as a business, and understanding what the drivers of that are. Cause it's not just, on the income statement. You can't just look at the bottom line of revenue minus expenses equals, net income. That's one piece of the pie.
Yep. Yeah. Your comment's so smart, Ben. 70% of companies that go bankrupt are profitable when they close their doors. Think about that. Yeah. People are like, well, how do they go bankrupt if they're profitable? Because there's the working capital requirements. You have your money caught up in between accounts receivable and accounts payable, and that number can be massive sometimes. And then you also have capital expenditures, property, plant, and equipment that you're buying that's not accounted for on the income statement. It's captured on the balance sheet and the statement of cash flows, but most people don't look at that. So cash flow is king. And really, cash flow drives intrinsic value, which we'll get into here later on in the episode. But that's why I'm like such a proponent of cash. Too many entrepreneurs, they build forecasts and budgets, and it's just a P&L budget. So it just comes down to profit. And they're like, cool. Okay, look at, we have profit for the month. We're good. And then it's like, oh, you need to do a distribution to cover your taxes. You need to invest in this piece of equipment over here. It's 150 grand. Or you have working capital and it's climbing because you changed your accounts receivable policy, whatever it may be. Next thing you know, that there's these cash shortages and, it kills a business. I was working with a doctor years ago, and, he hired me in to help him out with his strategy and just some financial pieces of his business. And he said, Steve, I got this bill. I owe, $1 million in taxes and I have no cash. Yeah. He had like 200-300 grand in the operating account, but he's like, how is this even possible? How do I owe this money when I don't have the cash? And when I looked at the books, it is like, okay, because you accelerated depreciation in the past and you have these other things, working capital. So you're showing on an accrual basis that you're earning profit. So you're paying taxable, you have taxable income here, but you don't have the cash because you didn't manage your cash. He ended up covering it, but he had to pull on his line of credit, and it was a big wake-up call. But so many companies, they don't have access to capital like that, and they could just be killed. So
yeah, that's so important. And just for those that maybe aren't as financially sophisticated, working capital and just AR, AP, basically it's the gap between when you're receiving funds from a customer versus when you have to pay your bills that you owe. And like a great example is I worked with some businesses that were supplying, Costco, right? So they were actually producing products that would go into Costco. And that's great. And you can, make all the sales to Costco and you can record those on your income statement as, received or as earned, but you haven't received the cash and Costco doesn't pay for like 180 days. So from the time you can recognize the revenue, you have 6 months to cover that gap before you actually receive the payments in cash. And so just break down a little bit real quick what that kind of looks like, and you have the capital expenditures alongside of that, and then let's kind of tie it into the personal side here.
Yeah, so absolutely. So another example, I was working with a company, and they had $1 million in working capital requirement. So the money that customers owed them, between the money they owe their vendors, $1 million, they grew by 5x in 3 years. They quintupled their sales, right? Quintupled their sales. Their working capital also increased at the same time. So it went from 1 million in working capital to 5 million, and almost bankrupt them. And so, yeah, it's just it's the money. There's other things in it. It's current assets minus current liabilities. I love how you explained it, Ben, just very simply, but it's the money people owe you versus the money you owe people. There's a delta, and you get to become the bank. So a lot of entrepreneurs are the bank, right? And they're loading this money. But if you have the capital behind the scenes to cover that, it can really hurt you. From a personal standpoint, I think this all relates. So we work with a lot of entrepreneurs and business owners as well. So you make all this money, or you're cash strapped. A lot of entrepreneurs are just cash strapped until they have a liquidity event, and then they have
especially if they're growing. To your point, right? Because growth requires capital.
Yeah. So a lot of entrepreneurs are actually broke. They have debt and lines of credit, and but then they have a liquidity event, and then all of a sudden they come across 10, 50, $100 million, and they're like, wow, what do I do with this? Or they have some success along the way. Their salaries start to increase. And they're like, okay, I put in my 401k, my IRA, they just put it in there. They trust a financial advisor, and they put it in other assets, but they don't really know what that looks like behind the scenes. For example, if you're paying fees, a lot of people are paying fees for their 401k in their IRAs, the underlying assets, and they're not aware of it. So you could put your money in these funds, right, that are underlying your 401k, and you could be giving away like 50 or 60% of your returns to a financial advisor. But you think, oh yeah, what's 2%? It's no big deal, but compounded over time, it's a major deal. So that's something really important to understand. Also, there's just a lot of talk from a personal standpoint where it's like, okay, debt is bad. All debt's bad. That's Dave Ramsey, which he has a lot of great advice out there about, like, hey, debt is bad. Avoid debt at all costs. But really, there's good debt and there's bad debt. You can use debt to invest in assets that will produce cash flow, and that's good debt. You can use debt to go buy the Louis Vuitton purse and go on vacation and buy stuff that you can't afford. That's bad debt, right? You're buying liabilities. So if you're using debt to buy assets, that's good. If you're using debt to buy liabilities, that's bad. And then from the alternative investment standpoint, I know a lot of people with money. People come to them all the time. They're pitching them and saying, hey, Ben, I got this new business idea. Hey, or do you want in? It's $500,000 to get in. You're going to make a ton of money. I'm going to make you so rich. And they don't really understand the fundamentals behind investments and cash flow and private equity. So then they tend to make some bad decisions, and they can lose a lot of money in that process as well. So that's what I loved our conversation when we were talking about alternative investments related to real estate, because I think there's a lot of upside. But unfortunately, most people don't understand how the alternative investment world works.
Right. Talk a little bit about this alignment of interest, because you've shared on your website, Boosting Your Financial IQ, that the financial advisors, the consultants, they don't always have your best interest in mind, right? And so you saw that in the business standpoint, where the consultants are coming and actually destroying businesses, but that also applies to the personal financial side, right? I see so many people, to your exact point, they make all this money, they haven't invested in the financial literacy. They haven't invested in the kind of 101, 102 level understanding of finances. And so they blindly trust an advisor, assuming that, hey, this is too complicated for me to understand. This is, I'm never going to be able to get to their level, so I'm just going to trust them. But there could be a misalignment of interest. There could be, things that you're not aware of that are actually hurting you, that would cost you a lot less to just invest into understanding some of the basics, right?
Exactly. So, and look, I know a lot of financial advisors out there in the fintech. We worked with a lot of financial advisors. I think there's a tiny little fraction that are like malicious and that want to like rip people off. Okay. However, I think it's important to understand that there's a difference between a fiduciary and a non-fiduciary. So if you're an RIA, a fiduciary, it means you have a legal obligation to act in the best interest of your client. So if I'm a registered fiduciary, which I'm not, but if I was, then as Ben, as my client, I would put him in investments that serve Ben in the most appropriate way. That's my fiduciary responsibility. However, if you're not registered as a fiduciary, you're basically a broker. And I could put Ben into whatever type of assets I want. So over here, I got this fund. It pays me a commission of, 25 basis points. Oh, this other one charges me at 35 basis points. I'm going to just put Ben in that, right? And I say, Ben, you're diversified in this fund. You have no clue what's the underlying asset of that fund. I mean, it could be invested in China and Venezuela and these other types of assets, geographically speaking, but then other asset classes. And it's just junk, but you have no clue, but I don't care. I earn my commission and you think your funds are diversified. And when the economy is going well, it's fine. You get your statement every month. You see you're earning some type of return. But when things go bad, they go really bad. And Ben says, hey, like, what the heck, Steve? And I say, sorry, did the best I could to diversify you, and
right.
And that's the conflict of interest. So I think it's like you could work with a fiduciary. You also have to be careful because I could be a fiduciary, but duly registered as a broker too. So I can market it myself as a fiduciary. Hey, I got your best interest, but I'm also, the back end here, I could still be a broker selling you high fee products and putting you in high fee products. So
right.
That's the misalignment there that occurs out there in the personal finance fields.
Yeah. Talk about financial freedom. Like what does that mean to you? How do you know as an individual you're financially free, right? I love you have a goal here of traveling to 50 countries by 50.
Yep.
You have freedom of time, freedom of money, and other things to be able to do that. How does someone know that they could be financially free, right? What are the kind of parameters that you have to kind of understand and be able to achieve?
Yeah, great question. I mean, when I was young, the idea of being like restrained was like terrible. I actually had a leash. My mom like put me on a leash. That's before like the leashes are cool. Like,
yeah,
it's like concealed as like a monkey backpack with a little thing. You're like, oh, how cute, a little leash backpack. No, I had like a straight up like dog harness on me because I was like wild running around the store. But I don't like the idea of being restrained, and I'm a creative. So I want to be able to go out there if I have an idea to go execute on it. So financial freedom to me means I'm not a slave to something that I hate doing. And Steve Jobs, he gave a great talk, through his commencement speech to Stanford, where he's saying essentially like, if you're waking up every day and you're like, what am I doing? Like, you're not free. So financial freedom, I know a lot of people that make $1 million a year and their costs are like $1 million a year. They're not free. I had the CEO I was working with, and he said to me a couple of years ago, he said, look, if I don't make 500 grand, at least 500 grand a year, like I can't cover my bills. So you could have $5 million and you spend $1 million a year the last 5 years, or you could have $5 million and you spend 200 grand a year. It could last you a long time. So financial freedom is having the ability to choose and pursue whatever you want to pursue in life. But it's based on, your income, but also your spend.
100%. I think it's your point earlier, having the knowledge and the literacy to understand these kind of things, right? Because if you don't understand what your expenses are, you don't have a budget, you're not tracking things, then you don't know how long, you could last, if you had to pull the plug on if you're a doctor or high paid professional or something. I saw this with, some family members of mine that, they were in the medical profession and had to work till they were, retirement age. And even then we're terrified that they weren't going to have enough to live because they didn't ever invest any time into understanding, these kind of basic financial concepts and cash flow and all that. So it was, there's so much, I think the financial freedom plays into financial knowledge and, but also the freedom of understanding that really opens up the whole, equation. If you can understand some of these basic concepts, it allows you to be able to do a lot of different things if you understand it. So
Absolutely.
I love that. Let's shift kind of the last kind of segment here. I thought was so interesting when we were talking before, just because of your background and working for some private equity backed companies. Talk a little bit about private equity as an asset class. This is something that, as I've studied some of the ultra wealthy, it's generally a pretty big allocation of their investments is into private equity. And this is differentiated from venture capital or angel investing, kind of the lottery pick of the next big tech company. But private equity is a tried and true model, leveraged buyouts. It's been, used for many, many, many decades with some great success. So talk about what that looks like and your experience in that, and maybe how it kind of relates to just some basic financial principles here.
Yeah. And I mean, the idea of leverage buyouts is relatively new, a few decades old. It's been, happening since the beginning of time, in some form or fashion, but it really became popular and private equity really exploded, just recently, back in like the late 70s, 80s, 90s. That's really when it started taking off. But essentially, when I talk about private equity, because private equity could be a general term for private money used for hedge funds and venture capital and real estate, things like you mentioned, Ben. But today I'll talk about it in regards to LBOs, leverage buyouts. The idea is you have a general partner. Okay. So you form an entity and you have a general partner, and that's the operator, the owner of this private equity firm. And they go out there and they raise capital from limited partners, LPs. So they go out to individuals or accredited investors and institutions, primarily like ultra wealthy people right now. And they say, hey, do you want to put in, $50 million into my fund? And they collect all this money. Then once they collect all this money into their fund, let's say it's $1 billion, then they earn fees off that fund. So the person operating the private equity firm, the GPs, the general partners, they earn typically 0.5 to 3%. On average, it's like 2% management fees on that committed capital. Then they take the money and they deploy it and they go buy companies with cash flow. Typically, it's companies with strong cash flow. Sometimes they'll buy distressed companies and do turnarounds, but most of them, they want to buy businesses with cash flow because they're going to pile on a bunch of debt. That's the leverage part, the L of the LBO. They're going to put on, 80 to 90% debt, and they're only going to put in like 10 to 20% of their own equity out of that fund, out of that $1 billion, to buy these companies. And it's really similar to real estate. So it's kind of like you buy an asset and then you get a tenant, and then the tenant pays you rent. You take that cash flow, use the cash flow to service the debt. Hopefully the property appreciates and you have some type of upside. Same type of thing with the business. With the business, it's a little bit different because when you buy a real estate asset, it's like a fixed building and you have a tenant and hopefully they don't go rogue, but that's the business model. With the business, you have like a bunch of wild kitty cats running the business and you have to like manage it and get in there and do strategy and make sure the products are good and you're satisfying the customers and the suppliers. And there's a lot more risk, but there's also a lot more upside. There's some real estate properties where you could buy and you could achieve substantial upside. But with private equity, you could buy a business for, $2 billion like Vista Equity just did. They bought a business for $2 billion. They invested in it, optimized it, and now they're exiting for $4 billion. So the upside's amazing, but you have to go in there and you have to like nurture the business and keep all those pieces together. And then when you sell it, that's typically what private equity firms do. Within 3 to 7 years, they're selling it to somebody else or they're taking it public. Then they earn money on the profits, which is called carried interest. They'll earn usually around 20% of the profits. And that's how a private equity firm works overall.
Yeah, no, I love that. I think, I've talked a little bit about private equity on the podcast here. And, back when I was a banker, did several kind of M&A transactions where you're helping people buy businesses. And what's so interesting about it is commercial real estate and private equity, as we're referring to it as, the leveraged buyouts, are generally priced on a multiple of cash flow. So it's a very similar valuation methodology where you're looking at what's the annual cash flow and, take out all the fluff and, then you price based on that. And what's interesting is, if you're looking at a valuation, real estate, commercial real estate, say for just a simple simple math, it generally trades around, say, a 5% cap rate, for a Class A property. It's a multifamily or something. That's probably pretty average, especially in, big metro areas. So that's a 5% cap rate equates to about a 20x multiple of annual cash flow. So $1 million, of annual cash flow times 20 is $20 million. That's a 5% cap rate. In private equity, they generally aren't trading for that type of a multiple, right? And for a lot of reasons, but to some of your points, one, there's not really an asset that's just there, whether there's a tenant or not, right? If you have a building that, real estate has generally been shown to appreciate over time as lack of availability and supply is limited. But in businesses, you don't always have an asset. A lot of times it's goodwill or just you're buying for the brand value. And so talk a little bit about just kind of valuations, like kind of what you've seen. And what I've also seen too, it's a really interesting private equity strategy, kind of a roll-up strategy is probably one of the most common is you go and you find, a really good operated business and you kind of use that as your anchor business model. And you go and acquire other smaller mom and pop businesses in the same industry. And as you can continue to grow and get scale, the multiples actually expand as you get bigger, right? So you can kind of buy a business for, say, a 3 or 4x multiple down at $1 million level. But if you can get to, 10, 20, $50 million in annual EBITDA, all of a sudden the value of that business goes up a lot. Just in the same amount of cash flow, you can actually sell that at a higher multiple because of the bigger money that's trying to get into the space. If you can create, scale, you can actually create value, which is really interesting in this kind of space. Talk a little about some of those things.
Yeah. So when you're building like a valuation model, when you're doing like private equity and looking at different organizations to acquire, you're looking at their free cash flow, and there's a formula. So you could look at the free cash flow into perpetuity, or you could look at free cash flow as a multiple, like you're alluding to, Ben. A lot of companies, for simplicity's sake, you could do a multiple of EBITDA, and it varies by industry. But let's just say, an industry with an average X and multiple of 5x on EBITDA. Well, if you're a smaller company, to your point, you're doing $1 million in EBITDA. Well, your multiple, on average, it's 5, but maybe somebody's only willing to pay you 3 because you're a smaller company. There's some key man risk, meaning that like if a key person leaves the business, customers can leave with them, or, employees can leave with them, or like the business falls apart because it's relying on one person. So there's some key man risk. And then there's like liquidity. If you take that money and you go invest in Apple today, I could go put money in Apple and I know like I could sell it, like I could buy it, I could sell it in like 10 seconds and I get my money back. Well, when you buy a company, there's all this due diligence, you're like locked in, and it's harder to like turn around and sell it. So there's some lack of marketability. There's a discount on that as well. But to your point, you go in and somebody says, yeah, you're only doing $1 million EBITDA. I'll give you 3x on your EBITDA. They give you $3 million. I buy your firm. And then there's another firm over here. I do the same thing. They do $1 million in EBITDA, buy for 3x. Well, now I have $2 million in EBITDA, and that's more attractive. Now I got more systems, more scale, like more reach. And now it may be worth 4x. And then I keep growing it. One day I have a portfolio of companies with $100 million in EBITDA, and that may be worth 6x. So just by combining them and rolling them up, to your point, it's called multiple expansion. That's how I can make money. Another way to do it is, I did this in the past, is the strategy was to buy a bunch of media companies, and we were buying media companies because, the idea was to collect, and combine all these companies in a roll-up strategy of financial media companies. But then if you take the data from these financial media companies and the behavioral analytics and all the other intrinsic value that's behind the scenes, well, now you're not just buying a financial media company, you're buying a data analytics and behavioral analytics company, which can be worth a lot more. So now you buy it at a 5x multiple, but an analytics company is more sexy, more attractive. There's more value with the assets, the intellectual assets that you own in the business. Now you're exiting at a 10x multiple just by changing the nature and the strategy of the business. So there's so many different ways to do it. Or you could buy a business and they're distressed or cyclical, like it's a bad cycle. You buy it when the market's down. Like think of like cruise ships back in 2020. I invested in Carnival and other companies with COVID. Their stock prices just tanked. And I'm like, okay, their stock is trading at a value less than their cruise ship value, the value of their tangible assets. So, you buy into a company like that when it's cyclical, things come back around, people start going on cruises more, the stock, increases, and then you can exit. And so there's strategies there as well as far as private equity goes. But I think ultimately it comes down to free cash flow, okay? Whether it's real estate or private equity LBOs or cryptocurrency or whatever it is, you're putting money into an asset, and then that machine that you're buying is going to spit cash back out to you in the future. And hopefully it's more cash. But I think so many people, they just get caught up in this idea of like, oh, I'm going to invest in this startup or this business over here. And look at their top line. They went from 10 million to 100 million. And like, they're so successful, I want in. Well, that stuff's all great and fine. But if you're not getting your cash back, that's what I care about. And you're not watching the free cash flow, that's where you could run into some serious trouble.
Yeah. Steve, this has been awesome. I really, really love just kind of bringing a thought to some of these concepts. And I think this is something that definitely people need to understand more of, and just financial literacy. So what's the best way, say someone is an entrepreneur, they're in a business, they're a CEO, they want some help on the consulting side, how they connect with you? And then also on the more just personal side of things, people want to up their financial IQ. What you have your two brands, share with us how people can get a hold of you to learn more.
Yeah, so I think the best way, if you just want to increase your financial intelligence, you could download our Boosting Your Financial IQ app. It's on the Apple app or Google Play Store. It's called Boosting Your Financial IQ. You get it on your phone, because I think, understanding the language of money should be as easy as checking your phone. So you could download the app. There's a ton of free resources in there, and you can just get started right now. And then the second way, if you want to learn more about like, hey, help me with my business, teach me more about like, how can I transform things and grow it to the next level? If you go to Coltivar.com, our website, Coltivar, there's a free masterclass, and you can check that out. And I explain this all in more detail, and I show you mathematically what I'm talking about. Like, I'll pull up an actual valuation model and show you, okay, you impact these drivers right here, these three things, and look at, you could take your valuation from 2 million to 10 million. So it's, there's the free masterclass on the website. Those are great things that you could do. But I just think listening to podcasts like this, I love what you're doing, Ben, with your base. I love what Aspen Funds does with providing alternative investment ideas for people to get in early and to do things far beyond just a 401k IRA type investment, which is fine, but you need more than that. I love and appreciate what you're doing there, Ben.
Awesome. Well, this is really fun. I can enjoy this conversation, nerding out a little bit on some of these things. Give us a little teaser. What are some of the classes or the resources in your Boosting Financial IQ app that people could get if they download the app? This is a free resource, right? Or is it paid?
It's a free resource. So I have master classes, 4 master classes on there right now. I'm constantly adding to them as far as like investing in different asset classes, just changing your mindset around money. There's master classes there. I have community conversations where I have people from all walks of lives that I do interviews with them. I have all the podcasts are essentially located there, but I also have tools that you could download, like financial models. A personal budget is on there. And then I just started a growth challenge. So there's a 4-week growth challenge on there. You can take part in every single week. There's a little activity to push yourself. So it's just all these financial tools and resources that are available to help you on a personal side and on the business side.
It's awesome. Well, Steve, thanks so much for coming on and sharing your knowledge. Definitely enjoyed the conversation. I'm sure our listeners will get a lot out of it.
Yeah, I appreciate you having me, Ben. This has been great.